It's Thursday, 17th of April, or Liberation Day plus 15, and this is your Capital Economics Weekly Briefing. I'm David Wilder. We are coming to you a day earlier owing to the looming Easter weekend, and Neil Shearing, Group Chief Economist, joins me once again to give us a spin through another busy few days in macro and markets. Hi, Neil.
Hi, David. Good to be out of the hot seat this week. Good to have you back.
Oh, it's good to be back. I've been away a few days. It feels like I've missed several years' worth of news cycle. But just give us a sense of where we are with this whole tariff chaos. Reciprocal tariffs were on, then they were off, then there was some sectoral tariffs relief, but now more tariffs threaten to be coming. So just give us a sense of what the state of the trade war is.
Yes, it's exhausting, isn't it? And there's a slight risk that what we say now on the morning of Thursday the 17th will be out of date by the afternoon of Thursday the 17th. We need to be a bit careful about that. But where we essentially are now is that the reciprocal tariffs, that's the country level tariffs that were imposed on other countries and announced on April the 2nd, that Liberation Day that you mentioned, they've been essentially rolled back to 10% for all countries apart from China. Alongside that, we still have those sectoral tariffs, so sector-specific tariffs on things like autos, steel, aluminum. But we've had a carve-out too from the reciprocal tariffs for consumer electronics, so smartphones, laptops, and so on and so forth. So what that's done is it's played havoc with our estimates of the effective tariff rates facing different economies, because you've got to think about both the level of the reciprocal tariff, but also the extent to which there are carve-outs for these items such as consumer electronics, but also there might be sector-specific tariffs on autos and the like as well. Where that's left us is that it's now really clear that the effective tariff rate on China is far higher than is the case for any other economy. So over 100% for China, about 106% effective tariff rate on imports to the US now, compared to less than 10%, for example, on Vietnam. So what had seemed to be a tariff regime that was really targeting producers in Asia on Liberation Day, that seems to be the main theme coming out on April the 2nd, was that countries in Asia were facing higher tariffs. Now it's really just China that's facing substantially higher tariffs and really colossal tariffs, over 100%. Everyone else at the moment, the effective tariff rate is somewhere around 10%, perhaps a bit below. So this is really now not a global trade war. It's not even a US trade war. It's a US-China trade war.
It's worth pointing out, though, isn't it, that those reciprocal tariffs, they've really only been put on ice. We've got a 90-day pause. What's the expectation of what happens when that 90 days is up?
Well, exactly. Now other countries are scrambling to get deals done. With the Trump administration, we saw this week a delegation from Japan in Washington left without a deal, but having had a meeting with President Trump, which seems to have gone well, judging by his social media posts. So maybe a deal is in the offing there. UK officials seem reasonably confident they might be able to close out a deal with the US. Vice President J.D. Vance has suggested that a deal with the UK might be close too. The same is true of India. Korea is on the list alongside Australia and the countries I've just mentioned that Scott Bessent, the Treasury Secretary, suggested would be a priority to do deals with. So other nations are really scrambling to do a deal with the Trump administration. We're not there yet. I suspect there's going to be many bumps in the road before some of these deals are done. They might just be temporary deals, holding deals that get us through to something a bit more fulsome later in the year. And then, as you say, we've got these cliff edges coming in 90 days time, well, less than 90 days now. So it's going to be a kind of frantic few months.
Do you see a world in which we're now working on the assumption that 10%, the baseline 10% will be permanent? Is that, do you think, the strategy here?
Well, I think it's fair to say no one knows exactly where this is going to land. Now, for what it's worth, we had factored into our forecast, we made an assumption within our forecasts the day after Election Day that the US would impose a 10% tariff on imports from all countries apart from China, and that China would face a 60% tariff. And I think it's fair to say we spent the first 6 or 8 weeks after the election encountering a fair bit of pushback to that view. That was quite an extreme view, and that this would create havoc in the global trading system, and that tariffs would ultimately end up at a much lower rate. Now, of course, a 10% baseline for most countries and 60% for China would be taken as a win, given the scale of the tariffs and the rate of the tariffs that have subsequently been threatened. So the 10% baseline that we put into our forecast is still there, and I think is a reasonable assumption on average. Now, some countries, I suspect, will face slightly lower rates in practice. Other countries might face slightly higher rates if they've got some sector-specific tariffs on top of that. And China, exactly where this lands, I think, is anyone's guess. But the idea that it's going to be substantially higher than other countries, I think, still holds. So for what it's worth, I still think a 10% baseline for most countries and 60% for China is reasonable. Some countries will have a slightly higher than 10% rate, given that the sectoral makeup of their exports. Some countries might have a slightly lower rate. The key countries to keep an eye on are, of course, China, but also Canada and Mexico. And this is all bound up too in the renegotiation of the USMCA agreement this year. At the moment, there are exemptions for all products that are USMCA compliant. How those negotiations proceed is going to be a critical factor to determine ultimately the trade landscape in North America and also globally over the next 3, 4, 5 years.
But there's this bigger issue, isn't there? There's this idea in markets that if we can just get past this tariff uncertainty, then we can all get back to business as usual. But we get to the 8th of July when the 90-day period runs out. Let's say we do end up with tariffs at this 10% baseline. We are still dealing with a highly unpredictable man in the White House. So this uncertainty, and he does thrive on uncertainty, doesn't he? That doesn't go away. So how do you do business in this climate?
It's extremely difficult. Now, dare I say, it's good news for macroeconomists because macro is back, and it's not just trade policy uncertainty. There's going to be a persistent theme, I think, over the coming years. There's also going to be uncertainty around investment policy, cross-border investment flows, technology as well. The other big news this week, of course, was the decision by the administration to place export controls on Nvidia H20 chips to China. That's about $12 billion worth of revenue for Nvidia. About 70% of all their shipments to China are these H20 chips. And it's bound up in this superpower rivalry that we've talked about before between the US and China. But it's another example of if you're thinking about where to locate production for semiconductors, these are multi-billion dollar decisions taken over multi-year timeframes. And it's incredibly difficult to make those decisions when policy is changing day to day, hour to hour. So I think there will be an impact here on business investment, and we'll start to see that in the Q1 data and extending into Q2. And it will have a depressive effect on outputs, yes.
Those curbs on Nvidia, they come just after Jensen Huang meets with Trump in the White House, makes this announcement of $500 billion investment in the US and comes away thinking that there's clarity on export restrictions and then gets hit with these curbs. So business is trying to operate in this uncertainty. And actually, it gets me on to this point that I know you've been in back-to-back client meetings in the past few weeks, and those meetings reflect a lot of the uncertainty that's out there and people wanting answers. But based on what you're saying, or with all this uncertainty, how does this not end up in recession, either in the US and or globally?
It's a good question. And you're right that the issue of the uncertainty caused by the tariff comes up in almost every client meeting that we are undertaking at the moment. How do you quantify this? What might the scale be? I think one point to stress is that specifically related to Nvidia, tech controls are not new. This is not a feature of the Trump administration. This is something that actually really gathered pace during the Biden administration. And so I think we need a bit of a reality check here that some of these measures are not unique to this Trump administration. However, it's certainly the case that when it comes to tariffs and trade policy, the uncertainty is much, much higher and it's off the scale if you look at various different survey measures. Now, how does all of that figure into the real economy? Well, consumer confidence has collapsed. If you look at the University of Michigan survey of consumer confidence, there's lots of concern and anguish around that. But really, it's not a very good leading indicator of consumer spending in the US these days. So wouldn't put too much weight on that per se. It's business investment, I think, is perhaps where there's greatest uncertainty, and it's perhaps more difficult to get a handle on. Now, obviously, that's a much smaller share of the US economy. But as I said earlier, these are decisions that are not just multi-billion-dollar in size, particularly over a long time horizon. It's impossible to plan if you're a multinational and therefore to invest. So I think this is an area that I think we should be watching over the coming weeks and months as the data comes in. Are there signs that business investment is starting to crater as a result of this uncertainty? Frankly, there's not much good survey data here. There's not much that we can really look to get a good sense of this. Some people look at different measures of trade policy uncertainty or policy uncertainty and plot it against business investment or GDP. But frankly, I think that confuses correlation and causation. Often when these measures spike, it's because the spike in uncertainty is caused by a cratering economy rather than the uncertainty causing the cratering, as it were. So there's not much we can really point to empirically at this stage, but I think it's fair to say that the degree of uncertainty is much larger than we would have anticipated. And so therefore the economic impact may be slightly larger. Now, for what it's worth, we've just published our US economic outlook. In that, our judgment is that if tariffs are rolled back to a level where most countries face a 10% minimum baseline, China faces a 60% tariff, the US economy just about avoids recession. We get GDP growth slow into kind of 1% Q-on-Q annualized, something like that. It's a marked slowdown, but we avoid recession. But if we're wrong on that, it will be because the uncertainty effects are much greater, or the dislocation caused by what's happening in financial markets turns out to be larger too.
Just to reiterate, and when will we start to see the hard data showing if things are falling apart? And what are the data points? I know we've got durable goods, US durable goods in the coming week, for example. What should investors be looking for?
So the first place to look will be the business surveys, particularly the manufacturing surveys. So ISM manufacturing PMIs, and so on and so forth. Given it's the manufacturing sector where tariffs will have the greatest impact, then we'll start to see over the coming months and quarters the effect in the hard data. So durable goods, as you mentioned, will be an obvious place to look. We'll start to get some surveys too, maybe of capex intentions by businesses, and that might give us some indication. So we'll start to get some of this data coming in over the coming weeks and months, but it's the surveys that will give us the first indications.
Okay, let's step away from the US for a second, working on the assumption that 10% tariffs do prove to be the rule. Looking elsewhere around the world, I know you've had loads of questions about where we see the economic vulnerabilities. What are you telling clients?
The first thing to get straight, I think, is the extent to which the dislocation in financial markets might have a feedback loop into the real economy, both in the US and elsewhere, and whether that might reveal some hidden vulnerabilities in the financial system. This is essentially unknowable. And there are some signs this week that strains in the bond market have started to ease. If you look at the long end of the curve, it's becoming a bit better behaved. Some of the incipient strains in funding markets have eased a little this week too. So potentially less worried about the dislocation in financial markets being a source of risk. But as it relates to tariffs specifically, for other countries, the two things to watch are where do tariffs end up? What's the level of tariffs that we're facing for each country and for each sector? And how dependent are those countries upon the US as a source of final demand? And there's uncertainty about both of those factors. But on the latter part, that how dependent are economies on the US as a source of final demand, there's a really big range in terms of how exposed countries are. So on the one hand, you've got Mexico, Canada, Vietnam. In each case, more than 20% of their economy is accounted for by exports to the US. So for these countries, I mean, saying US tariffs are an existential threat might be slightly overdoing it, but not by much. This is a really big deal. On the other end of the spectrum, if you look at the UK, about 2% of GDP is accounted for by exports to the US. A bit more than 2% in the case of the Eurozone, but not much more, kind of 2 to 3%. China's just over 3%. It's really Mexico, Canada, Vietnam that are extremely exposed. The rest of the world is certainly worse off as a result of US tariffs, but it's not disastrous. And then for China, the exposure is less extreme than Vietnam, Canada, Mexico, but they're potentially facing a much larger tariff, as we've discussed. So when we start to model the direct effect of tariffs on these countries' GDP, and we've just launched a tariff impact model where clients can plug in their own assumptions on tariffs, it's really Mexico and Canada that get hit by virtue of their large exposure to the US, even though they've got carve-outs for most goods. So we're still looking at somewhere between 0.6, 0.7, 0.8% off GDP relative to a pre-tariff baseline. China is about 0.6% off GDP relative to a pre-tariff baseline because of the high tariff rates. And then for most other countries, we're talking about 0.1, 0.2, 0.3% off of GDP relative to a pre-tariff baseline. The US, by the way, if you assume a 10% tariff on imports from all countries apart from China, where it's 60%, US GDP is about 0.5, 0.6% below its pre-tariff baseline in that scenario. So the US is hit relatively hard by these tariffs too.
Yeah, it feeds into this idea that the US is more vulnerable in this trade war than the Trump administration would seem to think. And that kind of leads me on to this question about inflation risks. I know you've been having loads of questions about that this week. Jerome Powell was speaking in Chicago yesterday. And he says, and I quote, tariffs are highly likely to generate at least a temporary rise in inflation. The inflationary effects could also be more persistent. So my question is, if COVID was this massive inflationary supply shock, why won't the almost complete stoppage of trade with China, for example, given it's the main supplier of goods into the US?
Yeah, indeed. And comparisons with COVID have been made. I think they're misplaced for a couple of reasons. One is that the inflationary shock that we had as a result of COVID was primarily because of lockdowns that affected not just external trade, but also the domestic economy. And at the same time, and led to a big shift in the allocation of resources between sectors and companies, and people moved jobs and some firms shut down, other firms sprung up. And at the same time, there was a surge in demand, principally because of massive fiscal support across the advanced world. So you had this surge in demand alongside massive dislocation on the supply side of economies. This time around, we're not getting that surge in demand. But also the dislocation on the supply side is not as great. So you say, for example, complete halt to trade with China. Yeah, maybe in the long term, if you have 100% tariffs that stick and 10% tariffs everywhere else, but I don't think we're going to get a halt to trade with China in the very short term. A lot of what China makes now, more than half of China's exports to the US, are intermediate goods. It's not just finished goods like toys and furniture. They're intermediate goods that are component parts for which many firms, at least in the short term, are not going to be able to source alternatives. So I don't think that we'll necessarily get a complete halt to trade. Firms will just have to pay the higher costs. Some of that will get passed on. Some of it will get absorbed in supply chains. Now, as for what all that means for inflation, I think Powell's right, really, that I think there will be at least a temporary rise in inflation. I think for the most part, it will be temporary. We're looking at a one-off shift in the level of the price of imported goods, but that level shift could be quite large depending on where tariffs wind up. So, for example, given our baseline assumption, which, as I've said a few times now, is 10% on most countries, 60% on China in terms of tariffs from the US, that would be enough to push core CPI inflation in the US up to just over 4% by the end of this year. So that's a reasonably large inflationary shock. It's not a pandemic-style inflationary shock, but we're getting from below 3 to above 4. If we were to get tariffs on the scale announced on April the 2nd, where we had that big billboard of different tariff rates for different countries, that would push US core inflation above 5%. So again, we're not back at the COVID rates of core inflation, where it was 6-7% plus, but it's a pretty big inflation shock. And even if that then starts to come down in 2026, as we would anticipate once this level shift in imported prices starts to work its way through the year-on-year comparison, it still leaves the Fed in a bind. They're facing a stagflationary shock, really. So the US economy doesn't go into recession, but we do end up, as I say, low 1% Q-on-Q annualized rates of growth. Core inflation probably over 4% in our baseline scenario. What does the Fed do in that situation? As Powell was hinting at this week, I think it's quite difficult to cut interest rates under those circumstances. So that's why we don't really have Fed rates coming down until 2026.
And how much does this all hinge on inflation expectations staying fairly well anchored? Because there are signs they're becoming a bit unanchored, aren't there?
Yes, inflation expectations are going to be an important part of this. Now, expectations matter, but only to the extent that then workers are able to act upon those expectations and bargain for higher wages. So there's several links in this chain. You need expectations to shift higher, then you need firms to bargain for higher wages based on those higher expectations, and you need firms to be able to grant those higher wage settlements in order for that to feed through into what economists call second round effects on inflation. So there's several links in that chain. At the moment, there's some evidence in surveys that inflation expectations are starting to pick up. We'll have to see how long lasting that is. But yeah, again, it's not what the Fed wants to see.
Everything we've been talking about, and actually the podcast you had last week with Mark Williams and Jenny McKeown, the whole story runs through this bilateral relationship between the US and China, doesn't it? The heart of this, the Trump trade policy. I know you've had loads of questions about how this US-China trade war plays out, but tell us what we're seeing here. Does this fit the framework of the process of global economic fracturing that you've talked about at length? Or are these 145% tariffs, are they just this clunky effort to get a deal with Beijing, and a deal gets done and this all goes away?
Well, I think you can view this through the lens of fracturing too. And I would say that, wouldn't I, given that we've written a lot about this, we've developed this view. I'm publishing a book on this subject later this year, which I've been starting to plug. So yeah, you would say, of course he's going to say that. But I think if you take a step back and look where we are, I think we can view this through the lens of fracturing. So to start off with, you've got the US and China going at each other in a trade war, tariffs on each other now well over 100%, while the US has imposed tariffs on the rest of the world at an average around 10% at the moment. The response to that in the business community has been that multinational firms are already saying that they're planning to serve the US market from outside of China. So Apple saying that it plans to increase production in India, for example, to serve the US. That is an example of fracturing in action. Then you have the US Treasury Secretary, Scott Bessent, saying that he believes the US can probably reach a deal with its allies on tariffs and then approach China as a group. That, again, is fracturing in action. And it's not just in trade that we're seeing this play out. We're seeing the response by China being to start to restrict exports of rare earth minerals to the US. Again, that's a fault line that we've suggested would be a key one in a fractured world. We've seen those tech controls that we've talked about imposed on Nvidia's exports to China. Again, another fault line in a fractured world. And if you look at what's happening in terms of global capital flows, lots of speculation that China was playing a key role in driving up yields at the long end of the curve by dumping US dollar assets. And you mentioned Mark Williams, he wrote a really good piece on this earlier this week. But also from the America's perspective, the America First Investment Memorandum issued a couple of months ago crept under the radar. But this, I think, gives us a blueprint for how the US is viewing investment in this fractured world and under the Trump administration. It explicitly encourages investment from US allies and explicitly suggests that there should be restrictions on investment from China. And shortly after this was published, we got an announcement from TSMC that it would invest $100 billion in the US, again, strengthening ties between the US and allies in strategically important areas like semiconductors. Yes, in one sense, it's true that tariffs have been announced in a slightly scattergun way. It's certainly the case that away from economics, the US has been ruffling feathers in traditional allies, particularly in Europe, over issues around security and defense. But when we look at trade, when we look at technology, when we look at investment, cross-border investment flows, I think there is a strong fracturing theme running through everything that we're seeing so far.
You mentioned strategic industries, you mentioned high tech. What about things like toys and furniture? When the dust does finally settle, and settle it must, will the US still be sourcing these sorts of goods from China?
Whether it sources them from China or not, I'm less certain, because if you end up in a regime where China is facing much higher tariffs than other low-cost centers, low-cost countries, then I think the logic is that production ultimately gets shifted to those low-cost centers. Howard Lutner was on the Commerce Secretary was on the networks a few weeks ago talking about an army of American workers screwing together iPhones. I don't think that's going to happen. I think this production is going to stay in low-cost countries because of the economics of production. If you look at manufacturing wages in the US, about $25 an hour. In Vietnam, they're about $3 an hour. So I think it's possible that some of this low value production gets shifted to other countries outside of China if we end up in a highly differentiated tariff regime. I don't think it's going back to the US. But that raises an intriguing possibility about what happens as a result of this massive expansion of productive capacity that we've had in Chinese industry over the past few years. Again, we produced a really nice piece on this earlier in the week, and the essence of which is that if Chinese producers are shut out from US markets, then it's likely that the production is going to find its way into other markets. There'll be some margin compression for Chinese producers. That might be helped by a weaker renminbi. But other countries from Europe to Asia to Latin America to India are at risk of facing this wave of Chinese exports that currently is going to the US. So I think the next leg in this trade war might be those countries starting to push back against imports from China. Now, I'm not suggesting that's going to happen immediately. I don't think this is something that we're going to see starting to develop over the next few months or even the next few quarters. But if you wind the clock forward to the second half of this decade, then if Chinese exporters are shut out of US markets, this production is going to go somewhere if Chinese domestic demand is extremely weak, and that's the root of these issues. If it goes into other markets, then I think it's likely that those countries will over time start to push back. So even if we start to get deals coming in between the US and its trading partners over the coming weeks and months, there's still this fundamental issue about the massive expansion of productive capacity in China, domestic demand in China being too weak, that production going somewhere else. And we're going to have these rolling spats over trade, I think, and these trade imbalances continuing for many years to come.
Neil Shearing there on the chaotic aftermath of Liberation Day and the future of global trade flows. He mentioned new analysis on China's appetite for dollars and the risks of China dumping goods in non-US markets. I will add both of those reports to the show notes. I'll also add that US economic outlook that he talked about, and for good measure, our take on the ECB rate cut, which was just announced as this podcast was being packaged up to go out. I also wanted to highlight the tariff impact model that Neil mentioned. This is what is being affectionately regarded as TIM around the office, and it's a tool designed to show you the macro impact of different tariff levels across countries. So you plug in your tariff rate, you choose your sectoral carve-out, and you see how much of a hit economies are going to get. You also get a measure of the impact on the US PCE deflator to boot. If you need to know where the vulnerabilities lie, depending on how this tariff situation unfolds, and frankly, who doesn't, then this really is a critical tool. TIM, our tariff impact model, is available to subscribers to CE Essential and CE Advanced. These are our all-access packages, and they come with our full suite of written analysis, a growing range of data tools, options for engaging with our economist team directly via our platform, and much more. Get in touch with your account manager to find out about Essential and Advanced, and if you are already on one of them but want to make sure you're getting the most out of the experience, again, do drop us a line. But that's it for this week. Neil and I will be back next week with much more from the Capital Economics team, including whether we're seeing the death of dollar supremacy. Until then, goodbye. Whilst this podcast is provided with all reasonable skill and care, it comprises the subjective views of our economists. Furthermore, these views are not opinions, nor do they constitute investment or financial advice, or are they guarantees or reassurances to the expected results of any investment products or outcome. You should seek your own specific advice in relation to questions you may have. We will have no liability to you in relation to this podcast whatsoever.